Hey everyone, welcome to today's Explainer. We're tearing into a truly massive and honestly fascinating data set today. We are doing a full financial health checkup on Griffon Corporation, trading under the ticker GFF. If you've been tracking this stock at all, you already know it is a complex beast, filled with some incredibly contradictory numbers. But we're going to cut through the noise, let the data do the talking, and uncover the true health of this company. Just to keep us moving smoothly, here's our roadmap. We'll start with the Griffon growth story, then figure out if it's fairly valued, take a look under the hood at its profitability and financial health, and finally, break down the dividend. All right, kicking things off with part one, the Griffon growth story, historical performance, and volatility. Let's see what kind of ride Griffon has taken its investors on. And buckle up, because ride is definitely the right word here. Talk about a roller coaster of extreme volatility. Back in 2018, the stock suffered a brutal 44% drop. I mean, that would have shaken out a lot of weak hands, right? But if you held on, it was followed almost instantly by a massive 97% surge in 2019. We saw similar explosive upward moves in 2022 and 2023, posting nearly 37% and 84% gains. And our most recent 2026 data shows an 11.4% gain. It's just a classic high volatility setup. So what if you had nerves of steel? If you held on through that wild ride and didn't panic during the down years, your 10-year total return sits at an astounding 583.91%. That is some serious wealth-building growth if you had the patience. What's really wild here is how the growth momentum is actually speeding up. A 10-year compound annual growth rate of 21% is already crushing the market, but the 5-year rate pushes past 28%. And the 3-year CAGR hits a blistering 40.59%. Historically speaking, this momentum has been stacking up aggressively. Moving right along to section 2, is GFF fairly valued? Decoding the market price. This is the million-dollar question, right? Looking at a chart like that, is the stock currently a bargain, or is it horribly expensive at its last close price of $81.85? We've got a classic Jekyll and Hyde situation here. A trailing PE ratio of almost 89 looks incredibly expensive. Any traditional value investor would run for the hills. But the forward PE is sitting at just 10.21. That is a massive gap, and it tells us the market is pricing in a massive earnings turnaround or some serious future growth. So which is it? With those violently conflicting price-to-earnings ratios, what is the actual intrinsic value of this business? Let's check out the discounted cash flow models to see what the raw cash generation tells us. If we estimate value based purely on the actual free cash this business generates, both today and projected into the future, the fair value price is a staggering $171.46. Compared to a current price in the low 80s, that sounds like an absolute steal. Well, here's where the plot thickens. Based on that free cash flow, you have a fantastic 52% margin of safety. But if you calculate the margin of safety based on earnings per share, it plunges to a negative 132%. It's a total mystery. How can a company be generating so much free cash but look so completely overvalued on paper? Keep that in the back of your mind, because we're going to solve it shortly. Looking at a few other multiples, the price-to-book ratio is sky-high at 35, meaning you're paying a massive premium for their net assets. On the flip side, EV to EBITDA, which looks at the core earnings engine, is a much more reasonable 9.73, and price to free cash flow is just 13.53. The pattern here is obvious. Whenever we look at actual cash, Griffon looks cheap. When we look at trailing earnings or book value, it looks ridiculously expensive. All right, part 3, profitability and financial health, under the hood of operations. Let's see how efficiently this machine is actually running, and see if we can figure out why the cash and the earnings are telling completely different stories. First up, capital efficiency, which is absolutely key to long-term compounding. The 3-year average return on invested capital was a really solid 15.5%, but currently, it's dipped down to 10.3%. It's still a positive number, sure, but this downward trend tells us management is getting a bit less bang for their buck on their investments right now compared to a few years ago. Looking at the balance sheet, short-term liquidity is totally fine. A current ratio over 2.5 means they have plenty of assets to cover immediate liabilities. But we need to talk about the elephant in the room, a massive debt-to-equity ratio of 12.44. This company is highly levered, and that debt ratio is 47% higher than its 3-year average. All that debt means huge interest expenses, which drag down, yep, you guessed it, net income. And that brings us to a pretty harsh short-term reality check. While net income grew at a stellar 31% annually over a 3-year stretch, the trailing 12 months paint a different picture. Revenues are down slightly by almost 3%, but net income absolutely cratered by 81%. Boom, mystery solved. That huge drop in recent net income is exactly why the trailing PE spiked to 89, and why the EPS margin of safety looks so terrible. So, besides the heavy debt load, what else cratered that net income so violently? A massive, unexpected spike in their tax rate. The current rate hit almost 63%, which is over 120% higher than their usual 3-year average. Because taxes and interest hammer your net earnings, but are often adjusted out when calculating free cash flow, the actual cash flowing in stayed strong, while the on-paper earnings were just completely gutted. Finally, let's wrap up with Section 4, the dividend breakdown, shareholder rewards. Let's see how Griffon is treating its investors amidst all this financial chaos. Even with that terrifying 81% drop in recent net income, Griffon has successfully raised its dividend for 14 consecutive years. That shows a management team that is deeply committed to returning cash to shareholders, rain or shine. And these aren't just tiny token pennies thrown out to keep the streak alive. They have been growing the dividend at an incredible pace, over 20% annually across the 3-year, 5-year, and trailing 12-month periods. That is phenomenal growth. But, yep, you guessed it, another wild paradox to tie it all together. Currently, the dividend eats up almost 90% of their net income. That sounds dangerously high, right? Almost unsustainable. But remember that massive cash flow we talked about? When you look at the free cash flow payout ratio, the dividend only consumes 14% of the cash they actually generate. Which leaves us with one final, critical question you have to ask yourself. Given the massive drop in recent net income, the bizarre tax spike, and a mountain of debt, can Griffon keep relying purely on its free cash flow to fund these generous 20% annual dividend hikes? Or is the weight of that balance sheet eventually going to drag them down? The cash is certainly there today, but those trend lines are flashing yellow. So, is this a hidden cash machine or a value trap waiting to spring? Dive into those statements and decide for yourself. Thanks so much for hanging out with me for this explainer, and I'll catch you next time.